What's going on, everybody? It's Blandon here from Mortgage HQ, and today I'm going to show you how you can best structure your mortgage to pay it off 66% faster. Here's the thing, the wrong structure is going to cost you thousands more in interest. You're always going to feel like it's really hard to get ahead. While the right structure, however, will help you pay it off 66% faster, allow you to invest in properties earlier, and build that passive income sooner. I'm also going to review to you exactly how you can use revolving credit facility in your structure and how you can use interest rate averaging. Now, when I first started in this industry, I thought there was one best structure that everybody should be using. I thought everyone should use the revolving credit facility and use interest rate averaging. I was dead wrong. There are actually three things that you must consider when you're structuring your mortgage. Number one, flexibility. Number two, capability. And number three, certainty that you will smash that like button for the YouTube algorithm. So we're going to dive into each of these three key points. So let us look at a traditional $500,000 mortgage. So this represents your mortgage, and this over here represents your savings account. And because you should be earning more than what your mortgage repayment is, you should be having some savings accumulating in your account every paycheck, kind of like this. Now, for most families, if they were to pay off this mortgage really quickly, they should be putting all of their savings against the mortgage repayments. So they would just increase that repayment, and every single dollar that they pay extra will go towards the principal repayment. And if they put every single penny in there, they often will pay it off in 10, 12 years. But you're thinking, Blandon, if I paid every single dollar in the mortgage, I have no funds for emergency or holiday funds. You would have no flexibility. So let's look at a second way of structuring your mortgage with a revolving credit facility. So what we've done here is split this $500,000 mortgage into $450K fixed interest repayments, and then we also have a $50,000 revolving credit facility, which is on a floating interest rate, usually around 1% higher. So in scenario one, because you need your emergency and your holiday funds, you leave the money in the savings account, accumulating kind of like this. This money will be earning 0.05% interest rate because it's probably just a standard day-to-day savings account. In this scenario, however, if you've got $10,000 coming in spare every month, this money will sit directly in the revolving credit account like this. In this scenario, you're paying interest on $500,000 mortgage, and your savings will earn you 0.5% interest rate. While over here, because you've got the $30,000 sitting against the $50,000 revolving credit account, the interest is calculated on a daily. So what that means is, because there's $30,000 sitting here, we will only pay the interest on the difference, which is $20,000. And we would also pay interest on the $450,000. So the total mortgage interest charge is on $470,000. So in summary, your savings has effectively offset the mortgage. Now, why would you do this? If you understand, in this situation, again, if you increase the repayments, you cannot just take the money whenever you want, and you have to commit to that repayment. If you want to come down on that repayment, you have to break the mortgage. However, in a flexible home loan or a revolving credit facility, you can actually put as much money in as possible whenever you have it, and you can take it back out whenever you need it. So that acts as your emergency fund or your holiday savings, effectively replacing any savings account that you might have. Now, you might be worried that this mortgage here is actually plus 1%. To give you a better understanding, even 1% on a $50,000 loan where you don't pay off any of the mortgage is only going to cost you $500. So worst case scenario, you would just pay $500 extra, but you get the flexibility of this account. But a revolving credit isn't right for everybody, because as you can see, in this scenario, the money is sitting in this account, and it's very easy for the client to just access this, so that if they're not disciplined enough with their money, then a revolving credit might not be suitable for them, and you'll end up paying more interest in the end. So this comes down to your capability. Your capability also determines how big of a revolving credit you should have. Typically, we would recommend how much you can save in 1 year as the revolving credit limit amount. So what that would basically means is, if you could save $50,000, you would put around $50,000 against the revolving credit, so that you can put your savings directly into that account each paycheck, so that by the end of the year, this revolving credit account will be fully offsetted and you'll only have a $450K mortgage that you have to pay interest on. And how it would work is, once you have paid off the revolving credit, let's say this is completely filled up, at the end of the year, your fixed mortgage will actually come off the fixed term. When it is on floating, you can actually take out this whole chunk of money and pay down your mortgage in one lump sum. And because you've taken out the money from the revolving credit to pay down your main fixed mortgage, you now have a $400,000 balance. And lastly, certainty. How do you get more certainty around your cash flow? Should you take the 1-year interest rate, 2-year interest rate, or the 5-year interest rate even? It's always hard to guess where the rate is going to be heading. Now, I remember a few years back when the interest rate was around that 5% mark, everybody thought that it was going to keep going up. Everybody fixed for 2-3 years fixed term. And since then, the interest rate has come down to 2.5%. Now, with the massive money printing in the economy, with the quantitative easing, inflation and rates hikes are inevitable, but we just don't know when that's going to happen. So if you run a business or your income is sort of fluctuating and you need a bit more certainty, what you can then do is actually split your loan into 3 or 4 chunks, kind of like this, where you'll take different interest rates. And by having 1 year, 2 year, 3 years, what you know is that at any given time, when the interest rate comes off for renewal, there is only one small chunk of your loan that is coming up. You know exactly what the remaining portion is going to cost you. So even if interest rate went up, only a small percentage of your mortgage is exposed to that higher interest rate, creating far more certainty. This is also recommended for someone with a big mortgage. For clients who have a smaller mortgage, I would say around 3 to 4 times their total household income, they can afford to take a punt on the interest rate and potentially look at a shorter term and not have the interest rate averaging. Now, of course, this is only a quick guide on how mortgage structure could work. It's always best to talk to a mortgage advisor who will look at your individual circumstance and give you the right recommendation on the structure. And if you want to learn more about how you can annihilate your mortgage, then join us for one of our free mortgage masterclass in the link in the description below. See you guys again.